Hi everyone, today we are talking about the tech stocks tanking and what we're seeing in the marketplace. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, and today I'm joined by Brian Yacktman and Elliott Savage. Hey guys.
Hey, it's going. How's it going?
All right, so wow, what we're seeing in the markets is really quite a change here. We're seeing tech plummeting, especially in the stocks like Zoom and even Tesla, really plummeting here. What are your thoughts on all of this, and are we seeing a rotation from value to growth? What do you think?
So it's possible that it could be a rotation from growth to value. You know, at YCG, we just don't think that you can predict any of these things, but we do think that it's important to kind of learn from history. And one of the people who's kind of a student of market history and specifically of market bubbles is a guy named Jeremy Grantham from GMO. And he's basically spent his entire career studying bubbles. And his view is that we're in a big one. And another thing that he likes to talk about is that when you see a bubble start to burst, what happens is that sort of the lowest quality, highest flyers start to burst first, and then it kind of moves up the chain and eventually gets to kind of the biggest stocks. And we're already kind of seeing a little bit of that trend with the SPACs, which were quite speculative. They've burst to some degree. You've seen a number of these smaller sort of disruptive tech companies start to kind of go down dramatically, even on great earnings. And then things like Dogecoin and other things, they're just, and even like you said, it's moved into some of the really large cap stocks like a Tesla. And so we would just say that it's a bit of a dangerous time and something for investors to be aware of.
Great points. I also am really curious about cryptocurrencies. So you're saying, you mentioned about Dogecoin and yes, it seems like it's a hustle like Elon Musk has said, and it's just plummeted as well. But it's interesting to see that, a cryptocurrency like Ethereum has gone off to the races and seems to be, trading in an opposite direction of tech. So I don't know if there's a rotation out of the tech stocks into, some of these cryptocurrencies, but we got to remember that these cryptos are very new, right? And it's going to be interesting to see where the institutional and, retail investor money goes from that standpoint. Any thoughts about cryptocurrencies or what you're seeing in the marketplace there, Brian?
Well, I just wouldn't go anywhere near them. I mean, even if there was a rotation going into crypto, I mean, it's just a pure speculation. It's a complete casino, right? You're just basically betting that you believe it will become an adopted belief network. I mean, essentially, it's an alternative currency. I mean, you just think of like what the dollar is, right? The dollar is just a piece of paper, and it's actually kind of funny the fact that we use dollars. And it's even more obscure to be using a digital currency, but none of that really matters. All that matters is, does it become an adopted belief network? And if it does, then some of these cryptocurrencies could really take off. I'm incredibly skeptical though of this whole Dogecoin thing. I mean, because that's just obviously, it's just a joke to begin with, and unlimited supply. I don't even know why people are messing around in that, to be honest.
Well, and I think it's really indicative of, some of the characteristics of the time we're in. It's sort of like the video gamification of investing, where it just prices going up. It's just like numbers on a screen. It's just sort of a fun thing. Hopefully you get rich quick. But it's just more indications of just, danger, frankly. And so,
yeah, for sure. And Will, coming back to just the whole tech thing, Elliott, if you're right, that maybe things are starting, not that you're right, sorry, if this trend that Jeremy Grantham points out, if that's really what's happening and tech's now starting to come down, I think a natural question would be, is now a good time then to be buying into tech, or is it the beginning of a great fall? And, at YCG, we just don't try to predict these things. But what I'd point out is I do think there's a difference between profitable tech companies and the ones that are the up and coming, who knows, potential winners. So I guess what I'm trying to say is if it's early on, a lot of these companies, we're in an environment where growth is likely to be constrained. That's the belief. And if so, then that makes anything that could potentially grow look extremely valuable. But the problem is that not all growth is profitable, because typically innovation comes in at capitalism, right? Free markets happen and it drives down prices and it drives down the returns for investors. And so we've seen it time and time again throughout history where high-flying, high-growth businesses end up getting extremely disrupted. And what ends up happening is the users of the technology benefit, but not so much the investors in that technology space. But I differentiate that from, say, types of businesses that create a network effect with high switching costs that have a long runway for growth in that industry. So like for us, for example, we like businesses like Microsoft or Adobe or Intuit, where we can see these network effects and switching costs that have led to a lot of profitability. And we take a lot more comfort in something that's generating lots of cash, high returns on capital, still a long runway to go. And this could potentially be a good time to be picking up businesses like that. But we're very skeptical of, can there be all of these becoming new winners ready to take over the world?
Certainly seems to be like a stock picker's market, right? Like the names that you've mentioned, there's clearly signs of pricing power and balance sheet strength that's just so critical when you're analyzing a business. And you compare that then to, a rack space or a real today that's just getting clobbered. And makes you begin to realize, okay, we really do have to look at the fundamentals here, which is something that, Warren Buffett and Jeremy Grantham have espoused. Is there a changing of the guard? I wasn't planning to bring this up, but, do we respect these longtime professionals and their opinion? There seems to be the younger generation kind of discounting what they're saying. What are your thoughts there, Elliott?
Yeah, well, actually, so I was going to say, Elliott, I don't know if that's the right question, Will, because I think that some of the old guard themselves are starting to change, right? I've listened to several interviews where...
That's a good point.
They're starting to adopt and say, hey, we recognize there are some things that are different. They always say those are the dangerous words, this time is different.
Right.
But there are times in history when this time is different. And I think some of these tech companies are some of the most profitable businesses in the world that require almost no capital at all and can yet generate additional growth with almost no reinvestment. How do you value that, right? I mean, that's incredible.
Yeah, it really is. Jeremy Grantham also was saying, an investor that, would do well if he were to go to all treasury bills right now. And we've talked about this in other videos about going to cash. Is that something that we would tell our shareholders and our investors? Going to cash is, we're seeing some red flag signals here with all the speculation going on.
Yeah, so I just wanted to dovetail on what we were talking about just earlier with the fast-growing tech stocks, and I just wanted to point out that generally speculative environments are environments. We as humans just naturally tend to be, we want to get rich quick, and we're overconfident in our ability to do so, and so speculative environments just kind of enhance that tendency. And if everyone's getting rich really easily and seeing things go up like multiples in less than a year, then that just attracts even more people like moths to a flame. And so there's always like some bit of truth behind some of the bubbles that occur. So there is a difference in terms of like network effects and returns on capital and things for these businesses. But I think what we're just saying is that in a period where you have massive gains happening in very short periods, that tends to just make us worried that maybe those stocks as a group are overvalued, especially when you consider that the base rate for kind of small growth is one of the worst base rates in terms of performance over time. And then if you contrast that with something like an Apple or a Microsoft, few people think that they're going to get rich like tomorrow in Apple and Microsoft. So they're kind of more boring, more steady, with huge cash flows. And we think that those are the types of businesses that tend to be undervalued over time. And then I would also just point out that in terms of your question, just to clarify, Jeremy Grantham, I think he said that in his view, being in cash might be better than being in the U.S. stock market, because he's very negative on the U.S. stock market. But he still thinks that there's value to be found in the international markets and international bonds, I think, as well. So I just don't want to. But from our perspective, we don't think that that you can kind of predict any of that stuff. And so we think that just the best balanced approach is to have enough cash that you can sleep well at night, and that you can take care of your short-term, 1 to 5, couple year spending needs, and then to have the rest of the money invested in these dominant businesses that if things go wrong, you can, they can buy back stock, they can take share from their more distressed competitors. But if things go well, then they participate in that global growth through their pricing power and their volume growth opportunities. And so that's kind of how we think about it.
Great thoughts.
Yeah.
Brian?
And I was going to say that, if you assume the fact that nobody has ever proven to consistently time the markets well, and then you add to that, hey, if you can get a collection of these dominant global champions that act as toll takers on the economy over time, then that leads to our strong belief that the highest prices that you'll ever see on these businesses is far into the future. So from that perspective, even if prices are elevated, in our view, they're always a bargain relative to the future. Now, when I say that, obviously, as valuations go up, it does mean that the forward rates of return are lower in the future than they have been, as things have really gotten frothy. But the point is that if you can't predict it and you believe that the highest price is far in the future, then you may as well just hop on and just own a collection of these great global champions.
Great thoughts, guys.
And just the one other point I would make is that, one of the things that some people think is that markets are kind of mean reverting. But markets are much more like a biological system than a physics system. And so there's nothing that says that we're guaranteed a 10% return, forever on equities, and that equities are always going to go back to being priced to give you a 10% return. It could be that, just society changes, the perceived safety of the cash flows change, and that we just go back to a new scenario where the return that you're going to get, where you're going to be kind of around a 5% return, and then maybe it goes up and down and is around that 5% return. But even that is assuming a new mean. It's just all over the place. And so you just have to invest in businesses that you think can be adaptable to new environments, can survive really bad environments, can participate in good environments, and have just many degrees of freedom to react to change, which is the only thing that's constant.
Yeah, we just hope that this doesn't turn into a Japan-like scenario where you go decades with no future forward return, even though on a Shiller Cape, a Shiller Cape, which is a cyclically adjusted PE ratio basis, the Shiller Cape actually went up decades later, and it was still at a negative rate of return decades later. That's a cautionary tale. So I do think it does matter that you choose wisely what you choose to own.
Yeah, you got to keep in mind all these different scenarios, and I think during these painful moments, if you are overextended in the tech space with regards to your overall portfolio, it's times like these where you need to look at the fundamentals, looking at the types of businesses, because ultimately it is what you own and what price you pay. And owning great businesses that have these network effects, that owner operated, and that have good, compelling capital structures, pricing power, and long-term growth. Well, this has been a great discussion, guys. Thank you so much. Let us know your thoughts in the comments below and check out our other videos. Thanks for watching.